What's up, y'all? It's Kyle Fertilowski, your favorite finance major from Ferta University. We're at this nice gathering tonight and got some birds looking my way, so maybe see if we can nab someone's number tonight. Who knows? What's up, girl? Can I get your phone number?
You can get my Instagram.
No, just give me your number. Like Instagram doesn't even matter. Just give me your number. All right, guys, if that's any technical indication I've ever seen, she's into me. So I think that we're going to enact phase 2 of my plan and start talking to her a little more. I mean, what a great technical indicator from her.
Whoa! That is not how you use technical indicator.
How do you use it then, huh? You probably don't know what a technical indicator is. I am Kyle Fertilowski, the best finance major at Ferta U. Tell me what a technical indicator is.
Well, a technical indicator is a mathematical formula that is based on historic price movements that you can plot on your chart to help you make your trading decisions. So one way technical indicators can be useful is they allow us to use historic price movements to help us predict future price movements.
They also simplify price movements because, as we know, candlestick charts can be quite confusing sometimes, so this will help simplify and make those easier to understand.
Also, some technical indicators can give us additional information which isn't given by a candlestick chart and can help us make our trading decisions.
It'll also help us build a trading strategy, and it will bring objectiveness and consistency so that we can maximize our wins and minimize our losses. Trend indicators will help us determine if the market is in an uptrend or a downtrend and how strong that trend is. It'll also help us determine when to either enter or exit a trade. So now we have moving averages, and the purpose of moving averages is that moving averages smooth out the movement of a stock and make the trend clear. And it can also serve as a level of support and resistance, especially over longer time frames. So first, we have the formula for simple moving average, which calculates the average price of a stock over the course of the past number X days, which is however many days you want to calculate it for, and it plots that alongside the candlestick chart. And next, we have the exponential moving average, which is essentially the same thing as a simple moving average, but it weighs the more recent price movements heavier than the price movements longer back in a period. And the advantage of this is that the recent price movements are certainly more important than price movements from days ago. So this can be a more effective tool, especially for day trading and more short-term trades. So long-term investors often use a period of 50 and 200 days, while short-term investors, such as day traders, use a period of 8 to 20 days. However, 200 EMA can be a very strong support and resistance level, so it can be very useful traders. As you can see here, we have 3 strong resistance points, which then turn into 5 strong support points. And so next we have an example strategy. So we have 9 EMA plus 20 EMA crossover. And so we're going to want to go down here real quick. So the strategy uses exponential moving averages. It is very simple and effective for newer traders. And you want to simply buy when the 9-day EMA crosses above the 20-day EMA. So you can see here, the 9-day EMA is the blue line, so that crosses over this purple line right here, and you're going to buy when that happens. And then you're going to want to sell when the 9 EMA, the blue line, crosses back below the purple line, the 20-day EMA. And essentially, these crossovers can kind of indicate possible short-term trend reversals, which means that is effective when buying and selling. So that is pretty much it. So next, we're going to be looking at the anchored volume weighted average price, or anchored VWAP. And the purpose of the anchored VWAP is that it is similar to a moving average. However, in its calculation, it also incorporates volume, which is one of the most important factors in trading. And we'll explain that a little bit later down the line. And this will allow us to confirm trends. It can also serve as a support and resistance level, just like the moving average, except it is more directed towards shorter time frames, which is good for day trading. So first off, you're going to want to go to the indicators button up here. You're going to want to search up anchored VWAP, and you're going to see the one by Jamie's Pips right here. That's the one that we recommend. So you're going to choose that, and you're going to find the most recent point of reversal into an uptrend. So right here, we're going to get that exact point of time, and we're going to go up here to the settings, and we're going to type in that exact point of time right here. And that's going to give us this line that will serve as the support level for this. And as you can see, it kind of bounces off a couple times here. And this can just help us confirm that the market is in an uptrend here. And so if it right here, it kind of goes a little bit below, but it bounces back up. So we're not looking for a downtrend right there. However, if later down the line it was, say, down here, we could expect it to reverse into a downtrend. So this tool can just kind of help you determine that. And we can similarly look at the same thing during a downtrend. And we can look at the most recent point of time and go right here to the settings and type that most recent point of time in of the reversal into a downtrend. And this will set it as resistance levels. And as you can see, it kind of bounces a couple times here. And so for this one, we can see it break through this line, and that will indicate that it is most likely about to reverse into an uptrend. And obviously that can help us determine when we should enter the trade. So this is a very useful tool. And if I didn't mention before, right here, it is acting as support. And right here, it is acting as resistance. So, yeah.
Momentum indicators help us identify the momentum of a trend, or how strongly a trend is moving in a certain direction, and how likely the trend is to continue in that direction. If the momentum is strong, that tells us that the trend is likely to continue, and if the momentum is slowing down or is weak, that means that there's likely a reversal coming up. And when there's a reversal, that can help us decide when to enter or exit a trade.
So the first momentum indicator that we'll be going over is the RSI, or the Relative Strength Index. And how you're going to find this is you just go up to indicators, type in Relative Strength Index, and it should be one of the first things that pops up. And when you click on that, it'll show up down here, and when it first pops up, it'll look more like this with the yellow line in there. But personally, I just remove that. It's not super important, but you can kind of do whatever you want with that. It doesn't really matter. And the purpose of this indicator is that really what it does fundamentally is it tells us how strongly bought or strongly sold an asset is. And that can tell us about the momentum of a trend that the asset's in. So if the asset is really strongly bought, it's going to be in a strong uptrend. And if the asset's really strongly sold, it's going to be in a strong downtrend. So it can tell us about the momentum of the trend. And it can also tell us about possible points of reversal in a trend. Because if the momentum of a trend is slowing down, that can mean that the trend is stopping and is going to reverse into another trend. And those reversal points could be really good points for entering into a trade or exiting out of a trade that we're already in. And really basically how this indicator is used by many people is, as you can see, we have this line here at about 70 and then another line down here at 30. So when the RSI is above 70, that shows us that the asset is overbought, showing that it's in a really, really strong uptrend. And what you look for is for when the RSI goes from above 70 to below 70. That would tell us that the strength of an uptrend, or the really strong uptrend, is slowing down in momentum. And when that happens, that could tell us that the trend, that uptrend, may reverse into a downtrend pretty soon. So if we're holding the asset at that time, we consider selling to avoid losing money from that reversal into a downtrend. And pretty much the same thing applies when the RSI is below 30. So when we see it from below 30 and cross to above 30, that can tell us that the asset is in a really strong downtrend right now, but the momentum of that downtrend is decreasing or slowing. And that can tell us that we might be reversing into an uptrend. So in that case, we'd be looking to buy, because if we buy there, that means that we'll make a lot more profits off of that reversal into an uptrend. And that's one way that people can use RSI to their advantage. But another thing that is really, really useful about RSI is it has things called divergences, which are these lines right here. So I'll explain those real quick. So the first type of divergence is a bullish divergence. And what happens there is it's when the price is in a downtrend and we see the price make a lower low, but at the same time, we see that the RSI make a higher low. When that happens, when the RSI is in an uptrend, but the price is in a downtrend, that shows us that although we're currently in a downtrend with the price, the momentum of that trend is slowing down. And that can tell us that there's a possible reversal coming up, which is what we see right here as it continues into an uptrend. The other type of divergence is a bearish divergence, and it's pretty much the opposite. So we see a strong uptrend, and then we see the price make a higher high. But at the same time that happens, we see the RSI make a lower high. So that tells us that although we're currently in an uptrend, the momentum of that uptrend is decreasing, which usually results in a reversal. And right after we see this higher high, we see the trend pretty much just reverses right away. So for a real example on a real chart, I pulled up Bitcoin here. And first of all, we have a bearish divergence here. So we have a pretty strong uptrend here. And then we see the price make a higher high over here. But at the same time, we see that the RSI makes a lower high. So that's a bearish divergence, meaning that we're in an uptrend, but the uptrend is slowing your momentum and is likely to reverse. And that's exactly what happens pretty much immediately. We see this higher high, and then the price tanks right away and then continues in a downtrend for a little bit after that. Now, if we scroll over here, we can see a bullish divergence. So we see that we're in a little bit of a downtrend, not a super strong downtrend, but a little bit. And we see that the price makes a lower low. But at the same time that happens, we see that the RSI makes a higher low and a significantly higher low. That shows us that although we're in a downtrend right now, the momentum of that downtrend is slowing down significantly, which can tell us that we may be reversing into an uptrend very soon. And once again, pretty much instantly, we go right into an uptrend, and then there's a big jump in price right after that. So the next momentum indicator that we're going to be looking at is the MACD indicator, or the moving average convergence divergence. And how you're going to find this is just type in moving average convergence divergence, and it's one of the first thing that pops up. It's this one right here. And for this one, I personally leave on the default settings just because they're most commonly used by all traders and investors, and they seem to work pretty well. So I just leave those on. And what this indicator does is it basically compares two moving averages, a shorter moving average and a longer moving average. And it's a momentum indicator because it tells us when recent price changes cause the momentum of a trend to change. And when the momentum of a trend changes, that means that there's possibly a reversal coming up. And when there's reversals, we're going to look to either buy or sell. So here, right, we have the indicator, and I'm going to break this down a little bit. So the MACD line is this blue line. And this blue line, this MACD line, is the shorter period moving average minus the longer period moving average. And in this case, with the default settings, we have the 12-day moving average and the 26-day moving average. So this MACD line is the 12-day moving average minus the 26-day moving average. And that's what we can see here. When the 12-day moving average is above the 26-day moving average, we see that the MACD line is above the zero line. And when the 26-day moving average is above the 12-day moving average, we see the MACD line is below the zero line. Next, we have the signal line, which is this orange line. And this is just an exponential moving average of the MACD line. And with these settings, it is a 9-day exponential moving average of the MACD line. So basically, it's a moving average of the differences between the 12-day and 26-day moving average. And lastly, we have these bars here, which is the histogram. And the histogram tells us the difference between the current MACD line, and the signal line, which is the exponential moving average of the MACD line. So when the bars are green, that means the MACD line is greater than the signal line. And when the bars are red, that means the MACD line is lower than the signal line. Common strategy when using this indicator is to buy when we see that the MACD line crosses above the signal line while below the zero line, and to sell when we see that the MACD line crosses below the signal line while above the zero line. So if I scroll over here, I'm going to show you two winning trades with this strategy. So first, we have this situation where we see that the MACD line crosses above the signal line around here. So we'd buy at around this price, and we would sell when we ride the trade for a little bit and we see that the MACD line crosses below the signal line while above the zero line. So we'd sell around this price, and this blue line shows us the gain that we'd make off of that trade. And if I scroll over here, we have another winning trade. We have the MACD line crossing above the signal line while below the zero line. So we'd buy around here at this dot, and we ride the trade, and we'd sell when we see the MACD line crosses below the signal line above the zero line. So we'd sell at about this dot and this blue line, and once again shows us the wit gains that we'd make off of that trade.
Volatility indicators can help us determine how much a price is moving. We can compare current volatility to previous volatility to determine if the volatility at the moment is high or low. Now, usually, low volatility will then be followed by high volatility and vice versa. This means that volatility can be a good way to determine if there's going to be a trend reversal or breakout, which can help us determine when to enter or exit a trade. So now we have our first volatility indicator, which is the Bollinger Bands. And to activate this, you're going to want to obviously search out Bollinger Bands and EMA Bollinger Bands right here. And we already have that activated on here. And so we're going to want to go to the settings. We're going to want to set the period to 20 days and the deviation to 2. Now, you can use Bollinger Bands, and they tell us the volatility of a stock and whether the stock is being overbought or oversold. And the width of the shaded region inside here determines what the volatility of the stock is. And however close the price is to touching these outer lines right here indicates whether or not the stock is being overbought or oversold. So as you can see right here, these thinner shaded regions are points of low volatility, and these wider shaded regions are points of high volatility. And along with the second part, you can see that the price breaking out of this top line right here indicates that it is being overbought and that it is likely to decrease in price very soon. So you can see that it breaks out and then starts to move down. And then somewhere like right here, you can see that it breaks out the bottom line, indicating that it is being oversold and that it is likely to start to rise in price. So now we have an example strategy right here. And this is, you're going to want to use the 20 EMA Bollinger Bands with 2 standard deviations. And these outer lines can be used as support and resistance, which can tell us possible points of entry or exit. And you can also identify times of low volatility, which is when you want to be prepared for a breakout to occur. So as you can see right here, there's a points of low volatility. And as we know, points of low volatility are most likely going to be followed by points of high volatility. So we're going to see a potential breakout coming soon here, which does happen. So we can see the price start to drop right here, and it breaks out of this bottom line, indicating that the stock is being oversold, which will potentially be an entry point for you to go in and buy the stock. And as you can see, it starts to rise up and rise and rise and rise up until it touches this top right here, this top line. And that indicates that it's being overbought, and that will maybe want to be your exit point. So you're going to want to sell the stock and make your cash. So this is just one of 2 different volatility indicators that we're going to be going over. So our next volatility indicator is average true range, or ATR. And the purpose of ATR is that it tells us the volatility of a stock over a certain time period. And there are 3 values of true range, which is current high minus current low, current high minus previous close, and previous close minus current low. And now the true range is the maximum of these 3 values, and the average true range is the average of the true ranges over a certain time period, which is normally going to be 14 days. Now, this indicator, you want to go to the indicators, and you're just going to search up average true range. And basically, this is all based around the idea that volatility is cyclical, meaning that the periods of low volatility are followed by periods of high volatility, which we've already gone over, and that the periods of high volatility are followed by periods of low volatility. And this can help traders find the point when to enter or exit a trade, and once again, entering during low volatility and exiting after high volatility. Now, the average true range indicator, you're going to want to use a 14 or 20 candle moving average. And I said it's an EMA here, but you can use any moving average you really want. It doesn't really matter that much. So an example strategy here, you're going to want to do the 1.5 times ATR rule. If you notice a jump in price, you're going to want to calculate the 3 true range values and choose the biggest one as the true range for that candlestick. And if this candlestick has a true range of a true range of larger or 1.5 times the average true range, then it could be an indication that there will be a possible reversal or breakout. And you also want to look out for other indications of reversal, like price action, or using other indicators to confirm an entry before you do this. And you can also use this indicator to determine where to set stop loss, but we will talk about that in one of our future videos within this series. So as you can see here, you're going to want to take this, so you can see this candlestick, pretty high jump in price. So you're going to take the current high minus the current low, which will give us this number of 0.0062. And obviously this number is just for this example. This obviously will not be what your number is. And the average true range right now is 0.0036. So you want to take this number, 0.00062, and you want to divide it by the average true range. And that will give you this number, 1.7222 times the average true range. And that is larger than 1.5 times the average true range, which indicates that there is a potential reversal or breakout that is about to happen, and that it is a good point to enter. And as you can see here, it is definitely a good point to enter as it rises exponentially in price right here. So yeah, this is just a pretty good indicator. It's a lot more specific than the other volatility indicator we went over, but it is a little bit harder to execute in practice.
Volume is the measure of the number of shares traded within a specific time frame. This gives us information about how active or interested the market is in the particular asset. When the volume is high and the price goes up, that means that there's a lot of buying pressure. If the volume is high and the price goes down, that means that there's a lot of selling pressure. From this, we can predict future breakouts. If the volume is very high, that can indicate that the market is very interested in a particular asset, which will likely lead to a price breakout in some direction. We can also use volume to predict trend reversals or trend continuations.
So our first volume indicator is just called volume. So if you go into indicators and type in volume, it's this one right here. And when it pops up on your screen, it's going to look like this with just green and red bars, a histogram type of thing. However, what I like to do is I like to add this volume moving average with a length of 20. And what this does is it just gives me an average volume over the past 20 days. And the period that you use for this moving average really doesn't matter. It could be 75, 50, 30, something like that. The benefit of it is it just tells us how much or how little volume there is relative to the average. So what this indicator does for us is it tells us the number of shares traded within a specific time frame. So when the price goes up, we see that there's a green bar, a green volume bar, and when the price goes down, we see that there's a red volume bar. Along with that, when the volume is high and the price goes up, that means that there's a lot of buying pressure in that time frame. And if the price goes down and there's a big volume bar, that means that there's a lot of selling pressure within that time frame. And what all of this information about volume can tell us is it can help us identify trend reversals, it can help us confirm potential breakouts or catch false breakouts, and it can help us confirm trends. So I'm going to break down how you can use this in 3 different trends. I'm going to show you how you can use it in an uptrend, a downtrend, and a range market. And just so you remember, a range market is when the market's moving sideways and there's no clear trend. So to start us off, we have an uptrend here. There's obviously an uptrend. The market's making higher highs and higher lows all the way up to here. And what volume can tell us is if there's consistently higher increase in volume alongside any trend, an uptrend or a downtrend, that can show us that there's a lot of pressure maintaining that trend or maintaining the momentum of that trend. So in the case of an uptrend, if there's high volume, that means that there's a lot of buyers willing to keep pushing that price up. And what we see here is that most of the time the volume is pretty high and above the moving average, which shows us that the uptrend is pretty strong here. And along with confirming the strength of an uptrend, we can also use the volume to predict reversals. And how that works is when we see a high amount of volume on a candlestick, but the candlestick's price or the change in the price with that candlestick is very small. So the body of the candlestick is small. And that's what we see over here. We see a really small body of this candlestick, but a really high amount of volume, a really big volume bar. And what we see pretty soon after that is the price continues up for a little bit and then jumps up one more time. But not long after that, we continue into a downtrend for a little bit. So this, although it's a little bit early in predicting a reversal, it did pretty well predict a reversal. Next, we're going to look at a downtrend. So in a downtrend, it's the same thing. It's the same idea. If there's consistently high or increasing volume, that means that the downtrend is strong, meaning that because there's a lot of sellers that are willing to continue that downtrend. So in this specific downtrend, we see that there's pretty low volume and most of the volume bars are below average, showing that although there's a downtrend, it's a pretty weak downtrend. And the same principle also applies with reversals. If there's a lot of volume relative to the average of the trend or something, alongside a small change in price in the candlestick, that can indicate that the momentum of that trend is slowing down because the buying pressure and the selling pressure are evening out. So we see that right here with this candlestick. Right there in this candlestick, we see a really small red body with relatively high volume compared to all of the other candlesticks. If we look over here, there's a bunch of smaller candlesticks, and over here too. So that can tell us that there may be a reversal coming up. And what we see is that it does reverse into this big jump, and then it continues into an uptrend following that. And lastly, we're going to look at how we use it in a range market. So consistently low volume in a range market shows us that the market's really not interested in the asset at the time. In this case, we're looking at Ethereum. So in this time frame, in this period here, the market's really not very interested in Ethereum. So the price isn't going to fluctuate very much, and the range market is likely to continue. However, if the volume is high, then you got to prepare for a breakout, because that means that the market's becoming more interested in the specific asset, in this case Ethereum. So there may be a breakout into an uptrend or a downtrend, but you won't know quite yet. So what you're going to look for is to find a breakout. You're going to want to see a big volume bar alongside a big change in price. That means that there's a lot of buyers, or in this case, we're looking at the price going up. So that means that there's a lot of buyers willing to buy and push the price really high and continue into a breakout. So if we look over here, we see a really big volume bar alongside a really big candlestick. And that shows us that there's a breakout, which happens to be true, and the price gets all the way up to here. However, we can also use volume to help us catch false breakouts, which is what also we see over here. When the volume is low and there's a big jump in price, you don't want to necessarily jump right on that trade because it could be a false breakout. And that's because if the volume's really low, the market's not really convinced that the asset should go into an uptrend or break out. So right here we see that there's a pretty big volume bar, but it's nothing crazy there. And then over here we see these two huge candlesticks, but with really little volume. So that tells us that there's probably a false breakout and that the market isn't convinced enough to push it into a really, really strong breakout. And right here we see that the breakout pretty much just fails right away and the price crashes down here again. Our next volume indicator is called on balance volume. So if you go into indicators and type in on balance volume, it's this one right here. And what it is it's just this long blue line. What this indicator does is it's a cumulative volume calculation. So how the calculation works is when the price goes up in a candlestick, we add the current volume from that candlestick onto the previous on balance volume. And when the price goes down in a candlestick, we subtract the current volume from the previous on balance volume. And because the on balance volume is a cumulative volume calculation, on balance volume number doesn't really matter, but the direction that the on balance volume is moving in is something that we're going to look at and something that we're going to use in our trading. So just like I did for volume, I'm going to break how we use this down into 3 different trends as well. And to start us off with an uptrend, some things we're going to be looking for is if both on balance volume and the stock price are in an uptrend, that means that the uptrend is strong and is likely to continue in that uptrend and isn't likely to reverse. However, the same principles from RSI of divergences apply in on balance volume as well. So in an uptrend, a bearish divergence is when the on balance volume either goes into a downtrend or a range while the stock price is still in an uptrend. And what this means is that the momentum or the strength of that uptrend is slowing down, and that could lead to a reversal. So in this specific example, we see that we have a pretty good uptrend here. And for this time period from about here to here, the uptrend is actually pretty strong because alongside the uptrend in price, we see an uptrend in on balance volume. So the uptrend is strong and isn't likely to reverse here. However, after here, we see that the price still stays in an uptrend, but the on balance volume goes into a range. And this is a bearish divergence. So after this, we see that the price has some weird fluctuations here, and then it continues into a pretty strong downtrend. So in this case, we actually would have made a little more money if we held on up until here, but still, if we bought here and sold here, would have been a very good winning trade. So now in a downtrend, the same principles apply. If both on-balance volume and stock price are in a downtrend, the trend is likely to continue and is a strong trend. However, the same principles of divergences apply. A bullish divergence is when the on-balance volume either goes into an uptrend or a range while the stock price is still in a downtrend, which, as I said, indicates slowing momentum and a possible reversal. So for this specific example, we see a downtrend of price. The price is making lower highs and lower lows, showing us a downtrend. However, alongside this downtrend, we actually see an uptrend in on-balance volume, and that's a bullish divergence, which tells us that the downtrend isn't likely to continue and is likely to reverse. And what we see here is the price actually reverses into a really strong uptrend, and we would have made a lot of money if we bought here and sold around here. Lastly, we can also use on-balance volume in a range market. So in a range market, if both on-balance volume and the stock price are in a range, the range is likely to continue, but you want to be prepared for a breakout because periods of low volatility, which is a range market, are often followed by periods of high volatility. So you want to be looking out and be aware of a breakout. So in a range market, if we see an uptrend in on-balance volume, that means that the range market has bullish tendencies and may break out into an uptrend. And if there's a downtrend in on-balance volume alongside a range market, that means that it may break out into a downtrend. So in this case, we actually see an uptrend in on-balance volume here alongside this range market. But in this case, the price actually doesn't break out. So that was kind of a false breakout. But it does still show that this range market has bullish tendencies. And after this uptrend in on-balance volume, we see that it actually goes into a range market here, bouncing in between this resistance and support level. And these are pretty strong resistance and support levels. It bounces off this resistance level 1, 2, 3, 4, 5, 6, about 6 times. And it bounces off the support level 1, 2, 3 times. So both of these levels are really, really strong. And in a range market, what we're going to be looking for in on-balance volume is if the on-balance volume breaks below a support level, that can tell us that the price may break out into a downtrend. And if the on-balance volume breaks above a resistance level, that means that the price can break out into an uptrend. So in this case, we see the on-balance volume breaks above this really strong resistance level at around this price point. And then it breaks out, and the price alongside that also breaks out. And we would have made a bunch of money off of this trade as well.
Lastly, we have confirmation indicators, which don't actually tell you anything new about the asset, but you can add them to your chart as a final requirement to meet before entering your trade to maximize your win rate and avoid entering losing trades.
So now we have our first confirmation indicator, which is called super trend. And before I go into this, I just want to say, very proud of you guys for making it to the end of this video. We're at the home stretch. We just got this indicator and one more before we are done talking about technical indicators for this series. So very proud of you guys, and I thank you tremendously for watching this video all the way up to here. So now let's get into it. So as I said, first one we're going to be looking at is called super trend. And how you're going to find this is you go to indicators, type in super trend, and it's this one right here by this Kivank whatever guy. So put it on your chart, and it looks like this. It's got these red and green areas with buy and sell signals. And really what this indicator does is really simple. It just gives pretty basic but pretty accurate, generally speaking, indications of when to buy or sell. And you can use this to confirm your trades when using another strategy. So here we have the MACD indicator with the 12-day and 26-day moving average, and we have the super trend to confirm our trades. So here we see MACD crosses above the signal line while below the zero line, which would be an indication to buy. However, we don't get a confirmation indicator. We don't get a confirmation indication from the super trend indicator. So because we didn't get that, we wouldn't buy. And what we see is that it actually just continues down. But then later on, we get the same crossover signal from the MACD line crossing above signal line while below the zero line. And a little bit after that, we get this green buy confirmation signal from the super trend. And Now we see the price actually go up and jump all the way up to here. And about here is when the MACD crosses back over. So we'd sell around here, and that's a pretty big profit off of that trade, while also avoiding a losing trade over here. Our next confirmation indicator is called Williams fractals. And how I find this is just on here, Williams fractals. It's this one right here. And what I like to do before you start using it is the default period is 2, and I like to set it to a period of 10 instead of a period of 2. And the reason for that is when you have it at 2, it gives a lot of buy and sell signals, but it's too much, and a lot of them are just really, really inaccurate. So setting it to 10 gives you less buy and sell signals, but the signals tend to be more accurate. And what this indicator does is pretty similar, but it finds points with high probability of a reversal. So a green triangle after the price is going up, that indicates that the price is likely to reverse and go down, and red triangles indicate that the price is likely to reverse and go up. And as you can see, these are actually pretty accurate. Right here we see the triangle and then it goes up, and here we see the triangle and it goes down. So it's pretty accurate actually, especially on the 10 period. And along with this, we have the 9 EMA and 20 EMA crossover strategy. The purple one is the 9-day EMA and the blue one is the 20-day EMA. So right here, we have a buy signal from the 9 EMA, 20 EMA crossover. We see the 9 EMA cross above the 20 EMA. And a little bit before that, we also have a red triangle, which indicates that the price is likely to reverse up. So we have this crossover and also a confirmation from the Williams fractals indicator that our trade is likely to be profitable. And then what we see as we ride the trade, as the 9 EMA stays above the 20 EMA, we see a few reversal signals here, but we ignore them because we're focusing on our main strategy, which is the 9 EMA and 20 EMA crossover, and we don't see the 9 EMA cross below. So we're going to hold the trade. And we hold it all the way up until here when we see that the 9 EMA crosses back below the 20 EMA. And right before that, we actually have a reversal signal that we can use as an indication to look out for a possible opportunity to sell. So here we have, so what we'd be doing in practice is we'd see this reversal signal and we'd be looking out for an opportunity to sell, and we'd be prepared to sell. And then after that, we're going to see the 9 EMA cross back below the 20 EMA at around here. And that's when we'd sell pretty much right away to make our profits from here all the way to here, which is a very profitable trade as well.
In this video, we went over multiple technical indicators, such as the trend indicator, which can help us determine whether or not the market is in an uptrend or a downtrend and the strengths of those trends.
Next, we went over momentum indicators, which tell us the momentum of a trend and how likely the trend is to continue in that direction or to reverse.
We also went over volatility indicators, which can help us determine the volatility of a stock, which can help us determine when to enter or exit.
Next, we went over volume indicators, which tell us how interested the market is in a particular asset. And lastly, we went over confirmation indicators, which you can add onto your trading strategy to avoid entering losing trades and maximize your win rate.